This is the Monday Call, brought to you by NZ Funds.
Good morning and welcome to the Monday Call. I'm James Gregor, Chief Investment Officer, and to my left I have Mark Brooks, Head of Income at NZ Funds, and to my right I have Andrew Catane, Senior Portfolio Manager at NZ Funds. It has been a long time since we've given everybody an update on where markets and where portfolios are tracking, so we thought what better time than as the weather gets a little bit better that we can start to unravel the almost year complete of 2022, but it's probably a bit hasty to say year complete because in this market at the moment, every week is something different and the volatility doesn't stop. But we were just speaking before we went live that the last time we updated everybody was just before the now infamous meeting in Jackson Hole, where Jerome Powell talked about the fact that there is going to be no let up in interest rate increases and they really have to get inflation under control. A lot has happened since then, and so we're going to focus on that, but we're also going to focus on how we're positioned and what our strategy is to mitigate and capitalize on the investment environment. The way that we're going to talk about it is with reference to KiwiSaver. KiwiSaver growth is around flat for the year, slightly negative after mitigating the downside throughout the year, and then coming into the close of the year, now participating in share markets as they rally. And we're going to touch on what we think is going to happen to share markets over the next couple of months. The inflation category is positive for the year, and the income category is incredibly positive for the year. Given the volatility in interest rates and credit, it's an outstanding outcome that's been achieved by Mark and his team. For those that are in the APS portfolios or the advised portfolio services at NZ Funds, those are a piecemeal or a asset allocation that is set up in the same way as KiwiSaver. So the way that KiwiSaver works versus our advised portfolio services is there's a portfolio of there's a opportunity to invest in 9 different portfolios, and the asset allocation that we recommend very much sits exactly the same as our KiwiSaver Growth, KiwiSaver Income, and KiwiSaver Inflation portfolios. And so when we talk about KiwiSaver and what we're doing within the KiwiSaver portfolios, it's really similar as to what's happening within the APS portfolios as well. So without further ado, let's go back to Jackson Hole, and it's probably the best place to start is probably with you, Mark, because everybody thought inflation wasn't going to stick around back in Jackson Hole. Powell told everybody it probably was, and then a lot's happened since. Do you want to give us a bit of a run through of what's gone on?
Yeah, sure, James. Morning, everyone. Look, I think it's probably even worth going a little bit further back and just sort of think about where we've come in terms of interest rates. Yeah, if we look at New Zealand, we started the year with an OCR at 75 basis points. But in the US, it was actually way down at 25 basis points. And yeah, clearly in New Zealand, we've been raising interest rates, or the Reserve Bank has been raising interest rates for some time. In the US, they started this year and they have been moving rapidly. But really, Jackson Hole was the catalyst to really speed that up. And ultimately, in a nutshell, Powell was sort of saying that they needed to materially increase interest rates quickly to get to a point where they were sort of definitely restrictive on the economy. And sitting here today, we're at 4% of the federal funds rate. So, that's a massive change. That's light years away from 25 basis points where it was at the start of the year. And since Jackson Hole, we've really seen an aggressive acceleration where we've seen 4 75 basis point increases. And clearly,
is that unprecedented? 475? That's probably a harsh question.
Yeah, certainly within the last 20 years, I think. Maybe if you go back to the 1980s and those events, I'm sure Volcker did.
But the delta was a lot different because they were at 17% rates, we're not at 0.
Correct, yeah. So I think from that point of view, they've moved quickly and rapidly. And, that's created quite a sharp market adjustment as people sort of went, what does this really mean for the world and going forward? In terms of, where we are in terms of what that means for the wider economy, it starts to actually sort of say that, at Jackson Hole, we were at a point where they were probably behind the curve. Now, generally, central banks are sort of at a point that they describe as restrictive. So essentially, the interest rate is high enough that it's starting to slow the economy. The question is how much, and that's often really what the markets are starting to try and grapple with. Before, it was kind of, in some ways, a little easier in the sense that clearly they, across the world, they were behind the curve. Now it's more a matter of, are interest rates at the right point, or do they need to go a little further?
I guess the analogy you can use, and correct me if I'm wrong, Mark, but it's sort of the end of the beginning almost of the cycle of increasing interest rates, and they always talk about this lag effect. What do they mean by that?
Well, ultimately, in terms of interest rates are a fairly blunt tool. Clearly, it impacts people's investment decisions, their mortgages, etc. But it also that takes time to feed through into action and impact. Here in New Zealand, it feeds through relatively quickly, but people have still got fixed rate mortgages, so they may not necessarily be impacted immediately by a change in the OCR. In the US, it is much more extreme in the sense that the bulk of people have fixed rate mortgages, which are very long term. Often, the standard prime mortgages are 30-year fixed. So people really are not impacted at all by changes in the federal funds rate. Corporate borrowers often, especially at the what I describe as the large end of town, the big corporates typically borrow fixed as well. So from that point, the impact of those interest rate rises is slower, and clearly it does take a period of time to feed through. And looking forward, that will be the challenge, and maybe it's jumping the gun a bit, but that'll be the challenge over the next 3 to 6 months. Is year to date, we've had a period where really the Western world has been raising interest rates fairly uniformly because of that transmission mechanism being quicker in some countries and slower than others. Then, as we go forward, I think you're probably going to get more dispersion in terms of interest rate actions by central banks, and that's going to create differences in terms of probably how interest rate markets perform, but more so probably currency markets.
So I think what we'll do from here is talk about the share markets now, and Andrew, we'll hand that over to you. And then what we'll do is we'll then circle back and go, okay, well that's our view, that's what's happened, and that's what we think is going to happen. And then let's talk about what's going on in the portfolios and how we can position for the next. I mean, at the moment, 6 to 12 months seems quite a long time, but I think we do all have to be disciplined and thinking further out. But Andrew, it's been an amazing year on share markets in terms of some of the records that have been broken, but the media love headlines. What has happened since June, since Jackson Hole, and the latest news around perhaps the beginning of the end of interest rate increasing? We've got earnings clouds, perhaps. Talk us through it.
Thanks, James, and good morning, everyone. Certainly been a wild ride in share markets this year. I think the previous periods you would have seen that had similar volatility to this would have been around 2008 and the financial crisis in the early 2000s, which was called the technology bubble pop. However, the moves we have still haven't got close to sort of the financial crisis downward movement in the share market. So in the financial crisis, we were down over 50% in the US share market. The lowest point that the S&P 500's been is sort of down around about that 27, 28% level. But what certainly has been similar is sort of the day-to-day, week-to-week, or month-to-month volatility in the market. So where we're at the moment is the US market is down 16%. So that's the S&P 500. The New Zealand market's down 13%. And somewhat quite impressively, the Aussie market at the moment is only down about 5%. But those numbers by themselves don't really give the picture of the volatility we're seeing, which has certainly shown periods in 1 month where the markets might fall or rise 10% in a single month. And what we've seen sort of since June, we had a period where the market sort of hit about its low point. And then the market went through a 17% rally. The term you tend to give it when it's not the bottom of the bear market is called a bear market rally, which generally means it's a big rally, but the movement overall in the market is still downwards. And that certainly happened sort of throughout the end of June, July, and into mid-August. The US market, as I said, was up about 17%. What ultimately stopped that rally was the Jackson Hole press conference that Mark and James were just talking about, which was when the Federal Reserve reset expectations for longer and higher interest rates as they needed to continue to combat this inflation. So that was a message to investors that, look, we're not through this yet. Inflation's going to stay high. We need to put interest rates higher, and share markets tend to not like sharp increases in interest rates. The valuations of companies tend to go down as interest rates are rising. So that's what put a brake on that rally, which was sort of mid towards the end of August, and that then pushed the share markets over into another downward cycle, which continued right through until about 2 or 3 weeks ago. The US market just touched its new lows, so the S&P 500 just sort of went through the bottom that it had seen back in June. And now at the moment we're in another period where we seem to be in another upswing for the moment, and this seems to be catalyzed for a number of reasons, but one was maybe the market starting to kind of absorb what was that sort of reset higher in interest rate expectations from the Federal Reserve. Another reason is we've actually had 1 or 2 data points which are maybe more constructive for the market, at least for the short term, and the primary one of that being the US inflation number that came out on Friday morning our time last week, which was the first inflation number on a year-on-year level below 8% was seen in quite some months, probably about 6 or 7 months. So we had a 7.7% inflation reading. The market was expecting it to be sort of in that 8 or slightly above 8%, so it came in below expectations, and the share market took that really positively because that's sort of what it wants to see in terms of controlling this inflation, and certainly there was a big reaction in the US with the US market had a one-day movement higher of about 5.8%, and the technology companies such as the Nasdaq was up sort of 8 to 9% in a single day. So it shows sort of how sensitive the market has been to those inflation numbers. The New Zealand market has also responded positively, but not quite the scale of those daily moves. We don't tend to see or as often the sort of 5 to 6% one day moves as we're seeing in the US.
And
this year.
why is that? That's often to do with not necessarily that the companies are any better. Not that I'm being disparaging of the companies in New Zealand. It's just a low liquidity, fully invested market where there's really no other place for people to go, so they don't generally sell as vigorously. Is that the case?
I think that's right. I think New Zealand's has got more long-term shareholders that own the companies. We've got a number of institutions who are not necessarily looking to sort of trade the 1 day or the 1 week movements in share prices, or even if they did want to trade short-term movements, there's not really the liquidity in the companies to do that. You can't really go and materially increase or decrease your position sizes. I think we also have a relatively high amount of sort of passive investors. A lot of these are overseas investors who allocate money all around the world, but they hold relatively large portions of the companies, and maybe not quite as much as sort of that retail day trading that's become a very big trend in the US recently, particularly since COVID. There's been just this absolute boom and kind of sort of people at home trading through financial applications and swinging prices around, and we probably don't have as large a percent of that in terms of the overall market.
Which is really attractive for, plus you get the really tax efficient dividends, and it's a high dividend paying stock market. And so I guess it's the reason why we've got big allocations to New Zealand shares in both the inflation and the growth category, because of all those reasons. You've got generally a lower beta, sort of lower volatile market, tax efficiency in your dividends, less volatility around the day trading, because day trading might be exciting for the people who are day trading, but it's something that is perhaps not as linked to fundamentals as one would like. And so having that allocation to New Zealand, despite it being a small market for a New Zealander, is actually quite a good thing.
That's absolutely right, and I think you touched on it, the type of companies in New Zealand. We are relatively heavy in sort of more stable, solid, regular cash flow businesses. You look at our energy sector and our gentailers, and companies like Auckland Airport and Chorus and Spark, and companies that are sort of infrastructure type companies that are very important to the economy. And we've got relatively lower exposure than maybe the United States does to some of these sort of high beta or highly volatile technology companies, which maybe have more uncertain prospects at a time like this when interest rates are going higher. And so I think that's sort of compounded maybe the volatility in US, which is quite technology company heavy, and New Zealand, being these sort of more stable companies that maybe seeing less volatility because of that.
So we've set the scene. Interest rate or inflation still high. We just may have seen the calming of interest rate hikes from here, or we may not have, depending on what the data tells us. But I guess what we are expecting over the next couple of months is, well, not much in terms of interest rate moves because there is no announcements coming. I think the next big data point is in not for a few weeks' time. And we're coming into the end of the financial year, especially in the US, where it's an important time where the trajectory of markets going up is something that everybody wants in the US. Mark, inflation is still at 7.7% in the US, down from its peak of 9.1. So it has come down, but it's still pretty high. New Zealand, it's still 7.2. Australia is still 7.3. We're not really out of the woods yet, but there is some opportunities within the credit and the interest rate space that you're taking advantage of. How are you positioning the portfolio? I know you're up, looking at your KiwiSaver income, you're up 16.8, 17% or something like that for year to date. And, you know, going into the end of the year when you have this sort of change in perhaps environment, at least for the short term, Andrew's touched on some of the things that might happen that might cause that to, you know, perhaps not be a longer term thing. What do you do with the portfolio in that type of environment?
Yeah, sure. I think before I answer that, I might just go back a little bit and talk about some.
I love the fact that when you have so much history in the market, you can always go back.
Well, not that far. But, I'm going to go back and probably deal with inflation a little more directly, in the sense of inflation is coming down from the peaks, but it's a question of, I think, in many areas as to how that inflation is made up. Yeah, it's certainly, as we came out of COVID and over the last couple of years, it's really been about the supply chain issue, and supply chains have been fraught with all sorts of problems, and it's made products very difficult to come by, and as a result, people have been willing to pay up for those products. That is clearly dropping, and I know one of your analysts, Andrew, has done some great work in terms of the shipping numbers, and maybe not to New Zealand, but globally, shipping prices are pretty much back to their pre-COVID levels. Is that right?
Not quite back there, but you're talking about shipping levels that went up about 7 to 10 times what they were. We're probably unwound about 70% of that, so we're still above. But I think on a forward-looking basis, Maersk, which is one of the biggest container shippers in the world, has recently said they're now nervous about prices maybe even coming back below where they were pre-COVID, which just shows you that how quick that change has been and sort of softening the cost and that logistical strain.
Yeah. So I think from that point, clearly that's a positive on the inflation front. But the real challenge in many areas is really around the services side. And in terms of, people, unemployment generally is very low around the Western world. And people are finding it difficult to get employees on the services side. And in the US, you now have services inflation above goods inflation. And even in the what was quite a positive number last week in terms of CPI, you had quite strong uplift in things like restaurant employees and restaurant wages. So you're seeing a push from that side, and typically that is quite sticky. Once that services inflation moves up, it doesn't really move back down to the same degree.
That's right. It's as a sort of a analogy of that. Which when I was traveling earlier this year in the US, and you go to a restaurant, you think things are supposed to be a bit tight for the consumer. These restaurants are packed, but the reason the restaurants are packed is because they can only open 3 days a week because they don't have any staff, and so it's a real tough one for some of these businesses because they literally can't continue to operate with the unemployment being so low.
So I think, from that point, that sort of suggests to us that inflation will come down, but it will be coming down relatively slowly, and it's kind of challenging to come all the way back to those sort of targets that the central banks want of sort of 1 to 2%. We're very much more in the camp of we're sort of a 3 or 4% type camp. So what does that mean?
An interesting data point on that, Mark, that we were looking at the other day is whenever inflation has exceeded 8% in the United States, it has taken around about 2 to 3 years on average for that to get back below 6%.
Yeah.
And so we went
let alone to their target.
Let alone the target, which is sort of more than that 2 to 3. And we went and tracked that over the last 100 years, and it's it's quite incredible. There are only 1 or 2 instances in the last 100 years where it was sort of less than 18 or 8 to about 18 months to get back below 6%. And once it exceeded 8. And obviously we got to sort of about 8.5, so we got to 9.1% was the peak we've had so far this cycle in the US.
Yeah, and I think at that point the real challenge becomes, central bank fiscal policy. So changing interest rates can only do so much. Really, the heavy lifting also needs to happen with government spending at that point. And typically, when you've had levels of inflation like that, it only comes down sustainably when both fiscal, so interest rate policy is tight, and actually government spending is quite restrained and restrictive as well. And clearly we don't have that yet in many places. We have seen, sort of since we last spoke, quite a strange situation in the UK where they look to try and increase government spending, and really the markets, I suppose, fought back and said, this doesn't work. You can't sort of push interest rates up and spend more at the same time. So what does that mean for the portfolios? Well, I think one, we're probably of the view that interest rates generically stay high, so position for that. But really, the other one is, if I look at most bonds, ultimately, is there really good value compared to where they've been for pretty much the last 5 or 10 years. Go back to, say, investment grade bonds. 2 years ago, you were probably getting at best 2%, 2.5%. Now you're getting 5, 6%. In some cases, maybe a little more. And those are really attractive returns. Likewise, if you sort of go out the risk scale a bit more, things like high yield. At the bottom, you were sort of getting 4.5, 5%. Now you're getting closer to 10. Those are returns that are pretty attractive, even if the path ahead's a little challenged.
What do you mean, just for the benefit of the audience, of a high yield bond versus an investment grade bond? Because there's quite a big difference in the return you expect from those.
Yeah, clearly. In terms of an investment grade, that would typically be your blue chip style name. So here it would be a Spark or an Auckland Airport or something like that. In a high yield name typically means a business with more debt. So our measure, rough and ready rule of thumb, is that debt to earnings before interest and tax, if it's less than 4 times, it would be investment grade. If it's more than 4 times, it would be a high yield position. So clearly the more debt you have, the more exposed you are to finding challenging times more difficult.
So I guess within the income space, the fantastic way that you've managed it, Mark, is despite the volatility, especially over the last week, for example, it's still been an incredibly stable portfolio, given you've been able to position the portfolio to not take too much risk on the big swings in interest rates and things that a bond portfolio that was just fully invested has. At the same time, now that you've had some great performance, then we were sort of buying from a position of, I guess, power and with some people call it in the industry dry powder, to then take advantage of some of these really great rates and some great companies that you can invest in.
Yeah, I think, and I know you guys hate this analogy that I use a lot, but I've sort of described running the bond portfolio a bit like farming, in the sense that 90% of your time is looking after the animals, making sure they're fit and healthy, and sharing them or drenching them or whatever is needed. But really, sort of, what we've had this year has been almost a once in a generation storm in terms of the speed of interest rate changes. And it's actually meant that because of that storm, not only have you had to sort of putting the animals in the shed wasn't actually enough, you actually have to take them right off the farm ultimately. And to put it in perspective, this is a little extreme, but somebody did some work on the 10-year part of the US interest rates, government bond interest rates. And that is sort of the benchmark, the one that people typically look at. And at the moment, this is, if we sort of end the year where we are now, this is the worst year for US 10-year government rates since 1786. So more than a 100-year flood, ultimately, from that point of view.
Just to test you, mate, what happened in 1786?
Been around a while, but not that long.
What we're trying to do within the 3 categories, so inflation or income, inflation and growth, is to make sure that the correlations are different. And while the market was correlated and bond markets went down as well as equity markets, they also have gone up together. Traditionally, they're actually uncorrelated and they do the opposite. And so it's been great that the stability of the income portfolio through I guess these change in environments over the last month or so, or even since Jackson Hole, has been a really stable ride for the conservative or defensive part of the portfolio. Equities and shares have been a slightly different beast over the last week or so, as Andrew, as we've definitely gone from some really negative numbers to you were explaining before, a really positive day, a couple of days last week. And I think when we reflect on it, if we could pick the turning point in markets, then I think none of us would be here, because we'd be able to be the oracle of lots of different things. And so you can never pick the bottom, but what you can do is think about what your long-term views are around what's going on in share markets, and invest accordingly. What that is going to create is some sort of negative performance event when the markets change. And last week we certainly, with the fact that we have a long-term view that there's still some clouds on the horizon with shares, we gave up a bit of our performance. But in actual fact, when we think about it and step through the year, the mitigation of the downside throughout the year has been outstanding. But at the same time, and when I think about the inflation category, you've got the ability to mitigate the downside, which you've been able to achieve really well through the year. But you've also got that part of the portfolio which is invested in really high quality shares. And actually, when you think about it, some of those shares even benefit from inflation. So you sort of got a double whammy there, where high inflation, they do well, but if inflation does start to reduce somewhat, although we don't think it's going to reduce back down to 2%, we've got a while to go there, they still do well just because of the general movement of the markets. Do you want to talk about how you're positioning, how you're thinking about the market going through to the end of the year, and the want of the market to go up, but also being cautious about earnings and what's going on with downside mitigation?
Yeah, sure. So the challenge you have in share markets is that they will move on a day-to-day or a week-to-week basis, sometimes on things which aren't completely fundamental. And so there's a lot of things that move the price of the share market, from down to how many investors have sold and therefore need to buy because they're underweight, through to the prospects of the earnings of the companies, through to the valuations of the companies, to what's happening on interest rates. So what we have to do in our job is we need to balance the sort of the medium term, long term with the short term, and find the right positioning. And what that generally means is, if I step through kind of the 3 time periods, the long term for share market is generally very positive. The long term movement of share market is going to be driven by the economic growth of the country you're in, the companies, and the sort of growth of the earnings of those companies, which in general, no matter which developed market you look through in the world, has been very positive over the last 50 to 100 years. And we see no reason that New Zealand or Australia or the United States, or the key markets that we invest in, do not have positive long-term prospects. So that's just sort of your base case. Share markets should return an 8 to 10% period over a 20, 30-year period, and we see no change of that. So we're biased to be long the share market. That's what we want to be long term. If you look at the medium term tends to be driven, let's say medium term is the next 6, 12, 2 years, is more driven maybe around factors such as, where is the valuation of companies? Compared to historic levels, are we paying a higher multiple of the earnings of that company? Where are interest rates, and where are interest rates heading? What's happening with the inflation story? So a lot of the stuff you hear us talking about is that fundamental medium-term view, which we're talking about. And then on the short term, it's sort of more subtle facts. It can be stuff like, what is the inflation reading next week? What is going to happen to that? Therefore, what will the market do? And sort of I guess from the shorter you go, the harder it gets to predict. Everyone will read a lot of books about Warren Buffett and saying, it's very hard to predict the day-to-day or the week-to-week movement, which is true. So what does that mean for us? Well, short term, I'll start with, I think we're leaning a bit more positive into the end of the year, certainly more positive than we have been over the last couple of months. I think there's a couple of reasons for that. One is the markets had a pretty big sell-off over the last couple of months. They sort of went down to the lows in the US and almost the lows in New Zealand. So we've flushed out a lot of the weak hands who were going to sell, and a lot of that sort of maybe some of the short-term retail traders or some of the overseas sort of hedge fund type traders had lightened up on their positions. We got that soft inflation number, which I just talked about before last week. And also you tend to, historically you tend to get a stronger period as you run into Christmas and year end. I know this sounds a little bit silly because you shouldn't be able to time it in certain months of the year where the market's stronger, but there is a strong statistical significant reaction or data point that in November, December markets tend to be stronger. And then sort of the reason for that people talk to is most companies have their financial year end at the end of the year. And companies tend to be sort of biased to sort of owning the stock market well during the last couple of months because the market always tends to go up. And so that tends to drive better performance. It won't necessarily happen. But I think with the setup we've had, a combination of the a lighter inflation number, maybe that means we're going to get a bit more strength into the end of the year.
So we will get a Santa rally.
There's been some big Santa rallies before, so maybe.
Well, remember, was it 2018? This is pre-COVID, so my mind is not as clear as it should be. But we had a really strong sell-off into the, I think it was into Christmas Eve when the market went down almost 20%, and then we rallied all the way back up and then reached new highs by the end of the year. And it's just that weight of positivity, which is great because that's what we want markets to do, because we want all our balances to go up, and we also want the country's balances to go up. So it's a positive thing that we should be celebrate. But also, what you're about to say is we also have to be a little bit cautious as well.
Yeah, and that caution that James has mentioned is because our medium-term view is still has a few storm clouds in it that we need to be aware of, and we don't think these are past. So I guess just to sort of run you through a couple of these, one would be we still have uncertainty on ultimately where inflation is going to, or how long it's going to take inflation to get to this 2 to 3% level, and how high interest rates will need to go to get it there. And until we have certainty on that, we have uncertainty on the valuation of companies. So company, as I said earlier in this podcast, the valuation of equities or shares in companies doesn't tend to like higher interest rates. So if we do get interest rates going another 1% or 2% higher, we will likely get downward pressure on the valuation of these companies. And what do I mean by valuation? Well, the most simple metric that investors tend to look at is the price to earnings multiple of the company. So that's the market cap of the company divided by the net income of the company. And so where are we sitting today? If I just grab the latest numbers on the US market, we're sitting at about a 17 times multiple of price to earnings. The long-term average is about 15.5 or 16 times. So we're sitting very slightly above that. In New Zealand, we're a little bit more expensive. We're at 22 times earnings relative to the long-term average of about 18 times. Now, that even though that we're slightly above the average levels, that's actually starting to become more of a positive thing, because we've spent most of the last 10 years trading at levels even slightly higher than this. And certainly where we were about 18 months ago, the US market was trading at around about a 27 times.
I was going to say, it's come off significantly. We've come back
a long way, and so that's starting to become a bit more of a positive. Yet I don't think it's still, on absolute terms, a positive driver, because when we've had these sort of periods where we've had sort of high inflation and we're having risk to the economy with high interest rates, or we're having a slowdown in economic activity, which we're starting to see in the US market, and I'll touch on that. Not in the US market, in most markets, which I'll touch on further in a second. We tend to get markets hitting a little bit below their long-term average multiples. So, an example might be the COVID sell-off, which it fell off about 30% in the US and New Zealand market. We went down to a multiple of about 13 or 13.5 times. Another period which we might say is a little bit more similar today was the technology crash in early 2000s. The market bottomed again at around about a 13 times P multiple. So levels at about 3 or 4 times below today. And that doesn't mean we're going to get there this time, but it does mean we may not quite be at the level where these valuations have bottomed out. The last point I'll touch on is earnings of companies. And so at the moment, we're starting to see a little bit of downward pressure to earnings of companies, and that's is starting to accelerate. So we've just been through the Q3 or the September quarter earnings in the US. Overall, so far, we've had about 85% of the companies that reported. The year-on-year growth for earnings per share is down about 5%. So that means the earnings is obviously falling on a year-on-year basis. However, inflation's running, remember, at around about 8%. So if you kind of look at that on an inflation-adjusted basis, we're basically declining the earnings of these companies by about 13% year on year. Why is this happening? Well, two reasons. One is we're starting to see some signs of demand weakness across the space. Out of the largest companies in the US, if we look at the 6 largest companies, 5 of those companies reported quite weak results, and out of those 5 companies, all of them guided to some level of sort of macroeconomic slowdown or economic slowdown was impacting demand. So some of those companies were Tesla, Microsoft, Amazon, Facebook, which is rebranded to Meta. So they're starting to see a little bit of demand weakness. And the other thing we're seeing, which is actually probably, in my opinion, the largest driver of earnings caution at the moment, is margins are coming down. Now, we've got to remember that margins expanded to a very high level during end of 2020 and 2021 as we had huge sort of demand and stimulus, and companies were able to push their prices up. But now it's starting to bite them, because what we've got is inflation is embedded in wages, and it's getting more costly for people to hire and retain staff, and they're having to put the prices up. And at the same time, the demand for their products is starting to weaken a little bit, so they're unable to sort of push that price increases through to their products. And so we had the margin levels for companies go from around about 13% prior to COVID. They jumped up to 16%. They've come back down by about 1% to 15% so far. And it's probably a reasonable assumption that this should head back over time to that 13% where we were earning before COVID hit. And so that's going to be a downward pressure on the companies over the next sort of maybe 1 to 2 to 3 years. And so if I come back to sort of overall picture, short term, yes, a little bit more bullish. Medium term, I don't think we're quite through what we need to see to be sort of be really bullish in sort of the medium term outlook. What does that mean for our portfolio positioning? It means we still want to hold some protection in our portfolios. So if we don't think some of these sort of key risk markets are quite done yet, then we still want to be protected in case we see more sell-offs. And we do know that these sort of volatile periods can go a little bit longer than you expected, so you need to keep that protection in there. So we still have what we call the insurance options in our portfolio, put options which pay out if the market falls, sort of levels of 5, 10, 15, 20%. At the same time, we still want to participate in these upward moves. We're seeing a little bit of an upward move at the moment, so we still want to make sure we own our shares and own our companies. We add to positions which maybe these companies have sold off more than they should have, or we add new companies which have been particularly beaten up over the last 9 to 10 months, and there's been a lot of those, particularly in the technology space. And keeping back to our long-term view, ultimately share markets tend to make 8 to 10% over 15, 20, 30-year periods, and we don't see any reason that won't be the case. We just need to get through the next, call it 6, 12, or 18 months to this inflation situation and interest rate rises come under control.
It's a great summary, and I know this sounds a bit tragic, but it's pretty exciting when I look across the team when we go downstairs onto the floor, and we've got a team of analysts looking at companies. And 2 or 3 years ago, we were looking at companies, and all of them looked overvalued. And really, it was about investing in the momentum of markets going up and interest rates coming down. Every time we have our research meeting at the end of each week, and the analysts bring the work that they've done, well, there's some exciting opportunities now. And not all sectors, and I think some of the earnings are under pressure on a lot of the sectors, but there are some other sectors that look pretty exciting. And it is the first time in some time that we can finally do this hard bottom-up, we call it bottom-up research, and start identifying companies that look really attractive, and buy them and hold them in size and hold them for the long term. And so I think the workload of the analysts just got a lot higher compared to perhaps what it was a few years ago. I think just touching on the growth portfolios. So as I said at the start, inflation is up a couple of percent this year to date. The growth portfolio is slightly negative year to date. It's, as we talked about, when we've mitigated the downside, which has been fantastic. And now we need to participate. Now that the environment's changed, we need to participate in the upside. And during that transition period, you always are going to give up some performance. But on the positive, we're reinvesting in the market from a real strong position of having mitigated that big drawdown where we didn't participate in that at all. And so, as I talked about within the growth portfolios, we've got a lot of exciting shares that we're looking at to invest in. And one thing that we haven't touched on is some of the other asset classes. And so when you get things like a weakening dollar mark, really positive for the commodity space. I don't know who wants to take that one because it's sort of an Andrew and Mark phenomenon, but with commodities and a weaker dollar, they start being a bit more attractive to those overseas buyers. And so that's certainly one of the drivers. And then the other driver is who knows what's going to happen within China. But they will come out of COVID at some point. And that's really going to drive commodity prices higher as well as and I guess unfortunately for inflation, drive up things like oil prices once they do sort of get onto a more even and normal positioning.
Yeah, most commodities globally are priced in US dollars, and so if the US dollar weakens by 10% versus other currencies, then that tends to be positive for those currencies in US dollar terms. And we had seen the US dollar against its trade-weighted basket of other currencies, so a sort of blend of key currencies such as the euro and the pound and some of the larger Asian currencies and Australian New Zealand dollar. We had seen that strengthen by about 20% this year. So the US dollar's had a very large move since the 1st of Jan, and I'm sure Mark will touch on that in a second, and sort of some of the drivers on that. But and so when you get sort of a 20% strengthening in the US dollar, that's sort of a little bit of a handbrake to commodity prices going higher. But over the last sort of week and a half or 2 weeks, we've seen that US dollar come off by about 7 or 8%. So that tends to be positive. James was sort of touching on China. China is incredibly important for energy commodities, in particular oil, and also most of industrial metal commodities. That's aluminium, copper. And so them coming out of lockdown, which will happen at some point, is going to be upwards pressure, and particularly the one that's probably been talked about a little bit more recently is oil, and oil prices started to come higher again. I think the prices are back above sort of $90 a barrel. They're not back to the sort of the $115 a barrel they got to just after the Ukraine war broke out, but they're starting to trend upwards, and maybe that's because part of that sort of the talk of China maybe coming out of lockdown at some point or getting ready for it. Other part is that we still have sort of some of the supplies not getting out of places like Russia, or not getting out as well, and it's having to be diverted.
And then even further back than that, we've still got, when we were talking about it in 2020 or 2021, around just the lack of supply versus demand because of the lack of exploration and
lack of investment,
and this green energy theme, that you can't just revert to green energy without going through a transition, and yet lots of countries have stopped exploring, New Zealand being one of them, and all of a sudden growth doesn't stop and you've got a lack of supply, and that's a long-term trend when we talked about this commodity super cycle.
That's exactly right. And so it's been just like most products, such as any investment product this year, it's been slightly tricking the commodity space, but it has been one of the best performing asset classes this year. In fact, I think there's only one or two asset classes that have made positive returns. One is, and one of them is commodities this year. So in terms of places where you've got the sort of best chance to generate returns has been in commodities space, even though that has been sort of up and down within various sort of month-to-month basis. So I think there's opportunities out there, and we will keep looking through all of them. We do have a little bit exposure to the energy space and oil and gas. We're still invested, as we have been for most of the year, in the agricultural space, which has been impacted by sort of low rainfall and the La Nina rain conditions, which have been going on for 3 years, which means high rainfall in some areas and low in other areas, and that's sort of put pressure on supply of grains such as corn and wheat and other grains, and the Ukraine war has sort of compounded issues there because they produce a lot of corn and wheat. So there's been no change in that position. Mark, I'm not sure if you want to touch a little bit more on sort of the reason for the strength of the US dollar and then the reversal in the last week.
I mean, currencies are often
notoriously difficult.
Yeah, I mean, they're boring until they're not, and then they're notoriously difficult. So walk us through it.
I think ultimately the strength of the US dollar comes back to financial conditions in the US. The Federal Reserve, through raising interest rates, has needed to, or certainly because of inflation, has needed to tighten financial conditions. And when that happens, that tends to be good for the US economy. Well, not good for the US economy, good for the US dollar. And they've tightened them a lot this time. I think relative to what we've seen probably over the last 10 years, the Fed, much like the Reserve Bank, has a dual mandate of both inflation and growth. And really, inflation has not been a problem over the last 10 years. So they've really had the ability just to focus on one side of their mandate in terms of encouraging growth. Now it's become that trade-off, and with inflation where it is, they've had to say, well, we want to actually really tighten conditions. That will come at the cost of growth, but that's the way it has to be to bring inflation down. And the dollar has responded to that, and it's up significantly this year. As a result, you would have seen, Kiwi got down to, I think, sort of a lows round, sort of 56 cents, somewhere around there. It's moved back up pretty significantly over the last couple of weeks. We're back above 61 cents here today. And that's really a reflection not of what's happening here in New Zealand, but very much a case that the US dollar has backed off in terms of this sort of, I suppose, market repositioning that had a relief of a better than expected CPI. But sort of going forward, I think our view is very much that those financial conditions need to stay tight. The growth in the US economy, much like here, it actually is remarkably robust. So, interest rates are going to remain, maybe not at their sort of, the scary levels where people suggested they might get to, being the 5 or even north of that, but certainly going to remain around these sort of 3 to 4% levels. And that has some implications for a lot of different businesses and a lot of different investments. I think in a nutshell, to me, that sort of says that when we've had ultra low interest rates, that's definitely meant that people could focus on assets which didn't necessarily generate an income. I think now with interest rates staying higher and sustainably higher, people need to focus and will increasingly focus on assets that generate cash. And that's good probably for bonds at 6 or 7%. It's good for a lot of New Zealand shares that have great dividend yields. And it will also impact things like the dollar in terms of where that money flows.
What's incredible about when we talk about the clouds on the horizon and what's going on in the US, particularly when we've been talking, there's been a lot of focus on the US or New Zealand market. Actually, when you compare it to other markets out there like Europe, they're in real trouble. And China is, they might come out of lockdown, but they're in real trouble in terms of China and its property market, and it's just over leverage and a market that's slowing. Europe has still high energy costs, really low growth, high inflation. They need to have high rates, but they can't really in terms of what's going on with the economy. So on a relative basis, if we do start getting a weakness in the global economies, perhaps there's the talk of recession in some economies. You want to be in the US dollar anyway, because on a relative basis, it's going to be pretty robust.
Yeah, exactly. And likewise, sort of Kiwi and Aussie was sort of, we haven't had a view banging the table that Kiwi and Aussie would go down. They've definitely moved down, not in the last week, but sort of this year with the US dollar. But at the end of the day, we've had a really positive terms of trade shock with, food is more valuable and we produce food. Whereas you go back to, as you say, go to Europe, and I saw a great comment over the weekend from who's the Chancellor in the UK, the Minister of Finance,
Jeremy
Hunt, making the point that the UK and the European governments have stepped up to cover basically a lot of the excess energy costs, the gas costs that people are bearing. And for the UK, that cost this year is likely to be the same cost as the NHS, their health service, which is just mind-blowing. Yeah. So, they have big issues going forward. Europe, you have double-digit inflation, north of 10%. You have interest rates still at 2%, 2 and change. They've got lots of issues there, and they've got a war on their doorstep. So, in many respects, our focus has been on the US, and that reflects that it's still, it's challenging out there, but it's a pretty good relative position. And likewise, here in New Zealand and Australia, probably likewise pretty positive as well.
I think the way that we invest has been well broadcast and well explained over the course of the last few years. But when you have an environment like this where where it's uncertain, there's two things that we always keep our mind on. One of them Andrew mentioned, and it's absolutely right, that in the long term, shares are going to give you your 8 to 10% per year, and that's something that the portfolios will predominantly be invested in. Same within the bonds and the income portfolios. High quality and some high yield, but high quality bonds with good cash flows are going to generate really great income for the defensive part in the portfolio and be a lot more stable in an environment that perhaps is a little bit more uncertain. But there are clouds, and we want to have the ability to invest in other asset classes that do well in this environment, commodities being one of them. We also want to be conscious of the fact that we're going to have not just a straight line chart upwards to the right in shares like we have, pre-COVID, which was 10 years, and there's a sort of obsession with getting back to that type of environment, which just we think isn't going to happen.
With interest rates where they are, it cannot happen.
And so having the ability to have downside mitigation when the share market does perhaps get a little bit rich, or there's some clouds around earnings or multiple compression or something like that is really important. And being able to take risk off when we need to, but also put it on and participate like we think is the environment going into the end of the year is really important. And we are an active manager. We invest the portfolios to reflect the investment environment. Markets change and turn, and at the moment we're going through a transition period where there is more positivity after perhaps inflation has, at least for the interim, being absorbed by the market. But that's not the only thing that's driving markets. There's going to be the next thing that comes over the horizon. I remember, how volatile markets were at the start of the year, and it's awful what's going on in Ukraine, but any news now in Ukraine really isn't affecting markets. There is always going to be the next thing, and making sure, given the amount of volatility in markets, making sure we have the ability to be able to invest and reflect that for our portfolios is exceptionally important. That's what we're going to continue to do. We're going to continue to be active. We're going to continue to invest in asset classes across different spaces. And then we're also going to make decisions that, some asset classes, shares and bonds aside, that we just don't need to be in as we transition through the next phase of the investment environment. So it's going to be a interesting next couple of months or month and a half towards the end of the year. And people tend to then take stock and then approach the start of the year with new themes and new ideas, and we'll be right there positioning the portfolios to reflect that. And it's a really exciting time because the type of strategy that we run means that we can really participate and take advantage of it. So
Can I rephrase that?
Yeah.
Do my version the way which I sort of see it? I think you've sort of summed it up beautifully. It's like, from the point of view of there are always clouds on the horizon. That's the nature of investment, and often people get concerned because of some event coming up. But frankly, there's always something on the horizon. But actually, it's a question of what the opportunity set is out there, and it seems to me to be one of the most exciting opportunity sets we've seen in many years. You've got bonds look interesting, shares are much cheaper than they have been, and commodities look to be at the early stages of a super cycle. So, for us, as you say, it's a really exciting time.
Anything more to add, Andrew? I think that's a pretty good summary.
I don't think I can add anything from what you guys have said there, so I'll be quiet.
Thanks very much, everyone, for tuning in this morning. This will be obviously replayed on the different places that you can get podcasts. And if you have any questions, do get in touch. We're more than happy to talk through our strategy, what's going on in the portfolios, how we're positioned, and what our strategy is. But until next time, looking out to the end of the year, have a great rest of the year, and maybe we'll touch base again before Christmas just to give a wrap up of what's happened. Otherwise, have a great summer and talk to you soon.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.